Hello and welcome. This is Jason Martin with AllGen's Market Update. Today is June 14th, 2022, and I wanted to take some time to look at what's going on with the market. I know there's been a lot of uncertainty with inflation, so we want to look at that. We want to look at what the Federal Reserve strategy is with the raising of the interest rates and quantitative tightening and all that. And then we want to look at how the markets are being affected, both the bond market, stock market, commodities, and then most importantly, how is AllGen managing risk and trying to protect our clients' assets during these times. So let's hop right in here. So the first slide that we are looking at here is inflation, and the inflation numbers just came out recently. And for the month of May, U.S. inflation actually went up, and it went up to the highest point it's been in over 40 years at 8.58%. You can see that's the purple line here. The orange line is core inflation. Core inflation would take out the more volatile food and energy, and it is still high. It's at 6%. However, it has been downtrending, albeit slow and still very elevated. And we believe that inflation will stay elevated for a while, but we're trying to figure out, along with a lot of other people, when it will actually peak. Whether it's going to be sooner or later. So with that inflation reading was higher than what a lot of people had expected, in the Federal Reserve as well. So what we're looking at here is the probability of how much the Federal Reserve will raise interest rates when they meet next, and they actually will meet as of the time of this recording, tomorrow, which is June 15th, 2022. And it's a pretty incredible that they're actually anticipating, or the highest probability, about a 95% chance that they will raise rates 3/4 of a point, 0.75%, or in the industry we say 75 basis points. And the reason why that's a significant thing is twofold. One, a week ago, if we look down here, a week ago on this chart, there was a 96% chance that they were only going to raise it 50 basis points. Okay, 0.5%. And then fast forward a week and to where we're at right now, and which in between that, the inflation report came out. After that inflation report came out, it really showed that there's now more need to do higher interest rates and raise rates at a faster rate. So right now they're going. The highest probability is that they will raise them 3/4 rate. That difference from what was expected is really what has caused the markets to go down significantly recently. And the reason why this is important to understand the direction of interest rates and what the Federal Reserve will do is because so many things in the economy are based off of borrowing costs. And so if borrowing costs go up, that's destimulative. So as the Federal Reserve raises rates, what can happen is car loans are more expensive, home loans are more expensive. If you have an equity line that's variable, that will start going up. Again, credit cards have a variable rate, they will go up. And within the stock market and different corporations, as issuers or companies who are issuing bonds, and that's how they borrow money a lot of times, they're having to issue those bonds at higher interest rates, meaning they have to pay higher interest, which hurts profits. So that's why it's so important. It takes money out of the economy, and it's all in the attempt to slow down inflation. So now the next chart we're looking at here is looking at where rates will be on the last Fed meeting of the year, which is December 14th, 2022. And as you can see here, the highest probability is right at about 3.5%. And a close second is, so basically anywhere from 3.5% to 4% is where the highest probability lies. And that would mean if we raise rates at that pace by the end of the year, it's factoring in, or it's pricing in, a 3/4 point hike in this meeting, and then at least a 50 basis points or 0.5% hike every meeting for the rest of the year. So that's what it looks like as we go to the end of this year. Now, if we fast forward a little bit further out to the midpoint of next year, July of 2023, and you can see the highest probability is somewhere between 3.75% and 4.25% of where interest rates will be. So if we do end up at the end of 2022 somewhere around this 3.5% to 3.75% range, then and what it would have taken to get to that point is we had to raise rates really fast. But now, from that point, the end of the year until July of 2023, over that 6-7 month period, you would only raise rates maybe a quarter or 0.5% from where the end of the year at. And that's important to know, because what happens, as I mentioned before, the Federal Reserve is raising interest rates in the hopes to stop inflation. Well, by doing that, they're slowing down the economy on purpose to slow down inflation. And if they do that at too fast of a rate, what can happen is you will go into a recession. And in a recession, a lot of times you do have downward pressure on prices, and there isn't as much demand to buy things and to pay for services. So that actually does bring down inflation. But now you have to deal with a recession and people losing jobs, and that's bad, and no one wants that. So the Federal Reserve, if inflation can come down by raising interest rates so fast and causing the economy to slow, then what will happen is they will then start to slow down the rate increases, and potentially even drop interest rates. And that's important for a number of things, especially bonds, which I'll explain here on this next slide. So what we're looking at here on this slide, the big section on the left, is looking at the 10-year US Treasury yield. And so this chart is charting the yield, not the price of the bond, but the yield of the bond. And it goes back all the way, you can't see the bottom here, it's 1962 is kind of where this chart starts right here. And then you can see interest rates went up a lot from 62 all the way to 81. And if you lived during that time, you may remember mortgage rates at 15%, CDs 10 to 12%, and inflation was very high during that time. In fact, the yields got up as high as almost 16% on a 10-year Treasury bond. But then you went in like over a 40-year period where interest rates came down, which is good for bonds, because the way bonds work, when interest rates go up, typically bond prices go down. It's an inverse relationship. So in the last 40 years, when interest rates have gone down, bond prices have gone up, and it's been a really good time for bonds over the last 40 years. That being said, what we've just experienced really kind of since last year, and especially has ramped up this year, is interest rates have gone up significantly. Now, these rates are a little bit different than the federal funds rate because these are market-driven rates, and the market tries to anticipate the future. So the market is pricing in, if you will, already that the Federal Reserve will raise interest rates significantly this year. And so you can see the 10-year Treasury yield right now is at 10-year highs. And so it's getting up close to like 3.25, 3.3%. And so what that means is, and why I'm showing this, because people will ask, well, if interest rates are going up, isn't that bad for bonds? And yes, that is bad for bonds, and it has been bad for bonds. And that's why going into this year, AllGen was very underweighted in bonds. And also for the bonds that we did hold, we tried to go with the less interest rate sensitive bonds. So if you go shorter term, sometimes you go short-term corporate bonds, which if the economy is doing well, those typically will hold up better. Getting Ginnie Mae, Fannie Mae, kind of mortgage-backed bonds typically also are less interest rate sensitive and outperform during rising interest rates. So we tried to be, one, underweighted bonds, but two, organize our bond portfolio in a way that should protect for bonds going down significantly, so that we wouldn't lose as much as a standard bond portfolio. Now, bonds have had a really rough time this year. They're down about 12%, which I'll show in one of the next slides here. But what I want to point out is bonds are already down 12%. Yields already went up a lot in anticipation of the interest rates going up in the future. And so what I did here on the right, if you look at this chart, we took all the worst bond market returns for a calendar year all the way back to 1928, looking at 10-year Treasury bonds, and then what happened the subsequent year, okay? And as you can see here, taking the worst returns, you had a 5% drop in 69, but then the next year you went up 16. You had another 5% drop in 87, the next year went up 8. And as you can see here, this is a big one, you went down 8, you went up 23 the next year, from 1994 to 1995. And then 99, you dropped 8%. And in 2000, you went up 16. So you can see here consecutively, when you've had a big drop in the bond market, the following year, at least historically, going back to 1928, for the biggest drops, there's been really nice sized returns the next year. And so when people ask, well, why would you invest in bonds when interest rates are going up? And it's because the a lot of times the bond market will already anticipate the future, and it's already gone up anticipating the future. Therefore, there's a good chance bond yields, at least on the free market, kind of 10-year, and just markets that trade in public, or bonds that trade in the public market, have already kind of factored in a lot of that. And now their yield is already high and their bond prices are low. So it could be a good opportunity for bonds right now. And so now going forward, and just recently, we started adding a little bit back into bonds, and we will be looking for opportunities to do more of that as we go into the summer months. So on top of the Federal Reserve raising interest rates, another way that they tighten the markets, that they try to slow down inflation, is by doing quantitative tightening. So what we're looking at here is a chart of the assets, the Federal Reserve balance sheet. And so when the pandemic happened, they did what's called quantitative easing. And quantitative easing is where you create money and buy bonds with the intention of pushing interest rates lower. And when you do that, what happens is it encourages people to invest. It stimulates the market, encourages people to buy things because borrowing costs are lower. Now, fast forward to where we're at right now. So as they do quantitative easing, they increase their assets on their balance sheet. And this chart is showing now that this is coming down, they're decreasing the assets on the balance sheet, which is called quantitative tightening. So not a lot of people are talking about this, but the quantitative tightening, they just started in the month of June, where they were going to be basically making money disappear. They created money by bought bonds. That's quantitative easing. Now they're basically allowing the bonds to mature and basically making that money disappear. The bottom line is, without having to know all the mechanics, is that's destimulative, and that can slow down inflation. It can slow down the economy, and it's something that we need to watch closely, and the effects that it has on the market. The last time they did it, back in 2018, initially the markets went down about 10-15%, but then they ended up eventually coming back. But it was kind of a shock to the system initially, and like it's been this time around as well. All right, so what kind of effect has that had on the overall markets this year, with all the Federal Reserve, raising interest rates, with the war, everything that's going on, with inflation being high? So as you can see here, the best, which is the pink line here, the best asset class has been commodities by far. Commodities have done really well. They're up 38% here. This is represented by the CRB index, commodity index. Gold has been the second best, which it is a commodity as well, and it's part of the CRB index, but that is a lot of times known as a safe haven holding, especially in times of inflation. And that's something that we held both of these asset classes going into the year, and have recently added to gold as increasing kind of a safe haven position in the portfolio, and as a way to diversify. Now, if you look here, the next one down is bonds, down 12%. And at one point during the year, bonds had actually fallen more than stocks for a brief period, back at the end of or during the first quarter and going into the second quarter. But since that point, stocks have really taken a bigger hit. Bonds have still gone down, but they've held up better now, which is traditionally how they do that. But this one right here is international. It's down 18%. Small caps are down 19%. So the worst market this year is actually the S&P 500, down 21%. And I make this point because, which officially is in bear market territory, but for the last 10 plus years, if you would have only held the S&P 500, you would have done much better than a diversified portfolio. But that's not really the way you should invest over the long run. And I think people have gotten accustomed to that. But typically, it is much better to have a good asset allocation, which is basically a mix of different asset classes, commodities, bonds, stocks, which ideally, when you buy those, you try to buy non-correlated assets, which means they don't all go up or down together. That way, when one goes down, another one can go up, and it'll balance out some of the losses. But the problem with that recently, this particular year, is bonds have gone down at the same time as stocks. And that's not always the case. In fact, over the last 20 years, a lot of times when stocks have gone down, bonds have gone up. In 2008, that was the case. Bonds went up when stocks went down, and that really protected a lot of especially the conservative and balanced portfolios that held more bonds. But this year, it's been really hard for those portfolios because a traditional portfolio, which would usually only hold bonds and stock, have all gone down together. And so that's why it's important right now that we be diversified outside of what I guess some would call a traditional portfolio of just US stocks and bonds, and hold other asset classes like commodities, and even, I'll touch on a little bit, emerging markets and international markets, to give further diversification. So again, just to point out, it is really important. That's one of the ways that we manage risk is to be well diversified and have a good asset allocation. And we have to kind of think a little bit outside the box of what a traditional, just pure U.S. stock bond portfolio looks like, I think, going forward to manage risk in the future days. So this is pointing out emerging markets. Looking at the yellow line here, you see emerging markets over the last month or so have actually held up significantly better than U.S. stocks. And when we went into the beginning of the year, and really over the last year, it's one thing that we have been mentioning is what we believe is a good opportunity is to start adding into emerging market stocks, and even actually emerging market bonds as well, because both of them have become a really big discount compared to U.S. stocks and U.S. bonds. This is looking at the stock side of the equation. And so the beginning of the year, emerging markets really outperformed and held up better. The war came along, which really hurt emerging markets. They went down a lot. But after that initial shock of the war, now it's kind of reverting back to the way it started the year, where emerging markets are starting to outperform again. And that's what this chart looks like, is what has the two, U.S. stocks versus emerging market stocks, what have they done after that initial shock of the war? And you can see that the emerging market stocks have significantly outperformed. And again, we believe this is an opportunity to diversify well, and an opportunity to potentially have a component of the portfolio significantly outperform in the future years. And we see that as a good possibility in emerging markets. Now, another thing that we've done to protect the portfolio, and also that a way that we're trying to grow the portfolio over time, is we have gone out or really reduced growth stocks, which we talked about in a few market videos over the last year or so, as being very expensive and very prone to a big drop. And we've been increasing value significantly. And so if you read this chart, the way it works is if it's going up, the line's going up. That means value's outperforming. And as it goes down, this line goes down. That means growth is outperforming. We've been pointing out that there's a potential trend change over the last couple of years, where value stocks were going to start to outperform again. And that really happened this year as this line broke out of this down resistance, or down trend line right here, and it broke above this resistance right there, which is kind of confirming an upward trend in the value stocks outperforming growth stocks. So this is an opportunity we see to not only protect the accounts, but also have better returns going forward. And really, if you go back further than just the last kind of 14 years, or if you look at like the last 14 years, growth has really outperformed. But if you go back 100 years, over that time period, values actually outperformed historically. But what they'll do is they'll kind of go through 10-year periods or so with one outperforming the other. And we think the pendulum is shifting to now value stocks outperforming again. So, a big part of managing risk is trying to see where things and asset classes are prone to big drops. One of the ones that we've been pointing out is growth stocks having the potential to really go down a lot because of how expensive they became. And you can see that this year, growth stocks, this blue line, are down 30%. So managing risk is not just about owning the right things, but it's also about avoiding or really reducing the areas that are most exposed to big drops. So by not owning a lot of those growth stocks, we've really protected our clients. On the other hand, we've been really overweighting value stocks, which is represented by the purple line, but specifically dividend stocks, and really dividend stocks with a strong balance sheet, which is represented by this Dow Jones US Dividend 100 Index. So that's another thing that we've done: overweighted value stocks over growth stocks. In between here, you kind of see what the S&P 500 has done, which it was down 20%. So another thing that we've really tried to avoid, that we're open to buying. We have an open mind about buying this asset class, but we hesitated just because we saw too many bubble-like characteristics, and that concerns us. And we really strive to manage risk well in not buying something that has the potential of dropping a lot is more kind of in line of how we will invest. And so if you look at Bitcoin and Ethereum and just crypto in general, but these being the biggest two, since November of last year when they peaked, they're down 60% and 70% respectively. Massive drops in those areas. And for all of those people who had crypto, who bought late, they're down significantly, especially if they continue to hold on. And this is just a lifelong lesson, and it'll reinforce this next slide too. When it comes to investing, you usually want to avoid the most popular areas. But by the time it's become super popular, whether it's investing in cryptos or investing in meme stocks or investing in the next hot stock or the next hot thing, by the time it becomes popular like that, it's usually close to the top. And it's really hard to buy before it becomes popular, but that's the better time to buy it, and when no one's really talking about it. But what a lot of your average investors will do is they'll hear all their friends talking about it, or they hear on the news a lot that a lot of people are making money, then they invest in it. And what happens then is that they typically invest over here once it's already peaking, and then they end up with very large losses. So really important to avoid those kind of really popular speculative areas in order to protect your account over time. Now, this next chart, kind of busy, but just highlighting, some of the most popular and even largest stocks out there over the last couple of years that really went up a lot. But these are the ones that we were talking about when we say we thought they were expensive and they were prone for a big drop. If you look at like Tesla, since it peaked kind of November last year, down 43%. NVIDIA, same thing, down 43%. Amazon, down 37%. We don't have Apple here, but Apple is actually down about 32%, which is another big stock. And then some of the more speculative COVID stocks would be like the Zoom and the Peloton. Peloton's down 87% just since November of last year. And Zoom as well, down significantly, 61%. Just from November of last year. So a lot of these were super popular stocks with COVID, and now they've dropped a lot. And then I think one kind of area that really points out these most popular stocks is an ETF that became really popular last year called the ARK Innovation Fund. And this ARK Innovation Fund, the portfolio manager was on the news all the time, became very popular fund, made a lot of money. When COVID happened and these technology stocks started going up a lot. But since November of last year, it's down 67%. So that's kind of, if you will, a little bit of an index of these kind of popular stocks. And as a whole, they're down 67%. And other big companies as well. Meta, which is Facebook, down almost 50%. Netflix down 72%. These are the darlings of, if you will, of Wall Street. And if you would have, got into those early on, you would have done really well. But if you would have got into them in the last couple of years, especially in November of last year, you'd be down significantly. And so again, part of managing risk is kind of knowing when to avoid something completely. And the way we do it from a professional standpoint is reducing your position size, especially in kind of an area that you think is really expensive. And that we believed that was large kind of tech growth last year. And we really reduced that significantly to try to avoid those potential losses. So to sum everything up, the way that we've been protecting our client accounts with all the high inflation, with what the Federal Reserve is doing, is we really trying to minimize or even avoid completely growth stocks, and avoiding like the momentum in the crypto stocks, and then overweighting value, which has held up much better. Dividend stocks with really strong balance sheets have done much better during these times, especially like consumer staples, food stocks, and oil stocks, and some of the stocks that got really cheap during COVID are now starting to do much better. And then we entered the year really underweight bonds, but we do see an opportunity now that bonds have gone down significantly, to buy at a pretty good price. So we've started adding to bonds. And then just being really well diversified outside of just a standard US stock bond portfolio, and making sure you hold some gold and some commodities, and even emerging markets we see as an opportunity to kind of diversify. And then we did a separate video on this, but rebalancing is something that we do for our clients, where if one area goes up and another area goes down, we sell a little bit of what's gone up and buy what's gone down, and that can help kind of keep or manage risk and over time, and helps you try to take advantage of opportunities after things have dropped too. And the last thing I'll leave you is this. It's really important, especially when times get bad, to avoid emotional fear-based decisions. And that's a lot of times can happen when you watch the news a lot and you have a lot of these bad messages, or you're constantly checking your account and watching every little zigzag of your account. And that can increase your emotions, increase fear. And we're in a partnership with our clients, in that we will try our best to manage your portfolios really well and manage risk really well, and look for opportunities to grow the portfolio over time. But it also, when it comes to a partnership, and our clients are really good and they trust us a lot, but it's important that you maintain that trust, and also try to avoid that really heightened level of fear that can cause you to make an irrational decision in selling when the market goes down a lot. I know it's very tempting. Everyone has that kind of feeling. It's a natural feeling. It's the way we're kind of built, fight or flight, kind of, it's our instincts. But it's really important, especially in the stock market and the bond market, not to sell based off of fear and when things have dropped, because it's easy to sell. What's a lot harder, and people don't anticipate this, is how much harder it is to get back in. And a lot of times you don't get back in until after the market's gone up a lot. Most people envision they're going to sell, market's going to go down, and they're going to buy at the bottom. That hardly ever happens. In my career, I've rarely ever seen that happen. What usually happens is people sell, market keeps going down. They're like, oh, all right, I was right. I made a good decision. Then the market comes up. They're like, oh, it's just going to bounce temporarily. It's going to come back down. Then the market keeps going up. They're like, oh, well, now it's too expensive. We can't buy now. Then it keeps going up. And at some point, way down the road, sometimes years down the road, they finally buy back in. They locked in a loss over here, and they missed out on a huge gain. And so we want to help our clients avoid making that mistake. So it's super important, not to make emotionally fear-based decisions. So I hope this helps. If you have any questions at all, please feel free to call us, to talk to your advisor about your specific situation. And if you have any questions, please don't hesitate to reach out to us. So take care. Thanks.